Good evening, guys. Welcome back to Not So Nice Show. So for this week's Not So Nice Show would be a special one because we will be giving you guys a treat. This week's Not So Nice Show will actually be a live session that we held, I think, a few weeks back, particularly for our Premium Club members, and we thought that the topic would resonate well with the general public as well. Hence, we decided to actually make this episode available to everyone on YouTube as to our subscribers. So do check it out. It will be on value traps, and we hope that you actually will take a few lessons from it and help you to avoid such potential value traps when you invest in your upcoming journey.
Hello. Good evening, guys. Hi. So welcome back to our monthly private session. So I thought this month would be a good month to actually, we look back what happened for the past year and what are the lessons that we can learn. And I thought of now that glove companies, I would say in terms of their so-called current predicament with what we what we predicted, or what KayaPlus predicted 1 year ago, and now with concrete conclusion, just try to show or share with everyone what actually transpired back then in our thoughts, in our thinking, and hopefully it will help not just you guys but also remind us that value traps are everywhere, and try not to get trapped in the next one that we may encounter. But before we go into the sharing, maybe I'll ask Chun Bing, what do you know about value traps, and have you actually encountered the value trap before?
I think value trap can be coming from multiple perspectives. I think one of the common one is, it seems like the stock that you're familiar with keep on dropping, and then the default thought you think buy the dip, and then it will rebound, and then it drop further, then you buy the dip again. So if you purely based on this kind of common thing that a lot of people might do, then you will fall into the trap. It seems like getting cheaper and cheaper compared to what you look at it, let's say 1 month ago, 2 months ago versus 1 year ago. Purely monitoring the price movement is the easiest way to actually get trapped. I think there are a couple of examples. I think, of course, the glove stock seems to be the one. You didn't manage to actually realize they already pump up it into a certain number, and then when you know about them, let's say you didn't follow them, it's already at, let's say, $10. So this is the first impression. $10 is the first time you look at it. 3 months later, something wrong, it dropped to $7. You think it's very lucrative, then you just buy, for example, without looking at any fundamental. And this is how you will fall into the value trap if you purely monitor the price movement without checking the fundamental.
Okay, cool. Now I think we'll go through our sharing today, the typical definition of value traps, and also what we think is also another definition for value traps, and how to actually detect and avoid them. Right. So of course, before we go into any sharings, a quick disclaimer: we'll be talking about real companies, but please do not take it as a professional advice to buy, sell, or even take a position in any of the shares. Do your due diligence, study and analyze further before making any investment decision. Right. So what is a value trap? If you go through the official definition, they'll tell you it is a stock or investment that appears to be cheaply priced because it has been trading at low valuation metrics, so such as multiples in terms of PE, price to cash flow, price to book value, and also for an extended time period. That means supposedly this company should be trading at, like what Chun Bing said, a PE of 20, right? And then suddenly the company PE went into 15 times PE. So meaning to say either the earnings drop or the share price drop, or stay flat even though the earnings went up. So that could be a mixture of both elements, or just a pure number one element only. So this could be actually one of the key signs that you might be looking in the value trap. Of course, at the end of the day, we want to buy things cheap, right? Investment is about buying things that we think is of value. If the price is right, we want to take a long position. But it is also important to be careful that we might end up buying onto value trap stock. So if you talk about normal traps or traps that we see on a daily basis, like mouse trap or hunting traps, straightforward, you know it's a trap, right? Because human intelligence actually makes us create all these things, and we use it to trap mice, right? So it's straightforward for you to see that's a trap, but it might not be the case for mice when they see cheese hanging onto a mouse trap. But the same thing happens when we go into the stock market. Right, value traps can be hard and deceiving. Sometimes you think it's not, like what Jun Bing said just now, the share price keep going down, and you just think like, okay, I'm going down, I will continue to buy, and sometimes down the road, after you unconsciously buy too much of it, then only you realize that I am actually buying into something so much in terms of the portfolio allocation, and you do not know when the share price will rebound back. So it can be hard and deceiving, but we'll try to actually figure out and look for some of the tips, and if given the time, you actually should run or escape before the trap becomes a bigger hole. So let's take a look at the example. So this is a company listed on the Malaysia Stock Exchange. I would say I stumbled upon this company back then, a few years back, I think, when I was actually looking for stocks via the stock screener. So I key in all the good metrics, like growth in revenue, they pay dividends, good cash flow, operating cash flow, right? So I actually stumbled upon this company. So this company is called Yong-On Corporation Berhad, or stock code KLSE-YOCB. So just to give a brief introduction on the company, it's established in 1966. So again, long operating history, has survived multiple financial crises. So the 1998 one, the 2008 one is still alive as of today. It's still operating as normal. So and started by trading and retailing linen and home linen, and also bed sheets and also curtains as well. So eventually they commenced into small scale manufacturing. So started off trading, and then they went into small scale manufacturing, and then they have their own so-called small integrated value chain where they manufacture and then they sell and marketing as well. Right. So this is just an example of Yong-On's or YOCB's products. You might have actually seen them before. I don't know if Jun Bing have seen Jean Perry pillow in any supermarkets in Malaysia.
Yeah, it's quite popular alongside with another brand. What's the brand already? I couldn't recall, but John Perry is quite popular. I mean it's a top 2 brand that you can see for pillow and all this bed sheet and so on.
Yeah, so it's something that we can relate to, even though not all of us actually buy it, but you usually will actually catch hold of this brand when you walk through the supermarket. So pillows, linens, bed sheets, and also curtains, right? Maybe boring business, but still a good business. And you look at their annual results, right? I wouldn't say it's sexy, but if you look back at the longer time frame, say since 2012 until 2021, there is some kind of a slow growth over there, right? So there are certain periods of years where the revenue seems flattish, but overall you can see, even though that happens, in terms of profit margin, it's still stable, right? Save for what happened in 2020, where the profit margin actually dipped down due to COVID, due to toughness or challenges encountered in businesses. But eventually in 2021, you see it goes back up to 11.2%, and very, very, very stable company, I would say. Never goes into losses like other companies out there that we are more familiar or more we are more familiar with. Like companies like Asia actually got suffered. Your plantation companies, your oil and gas companies actually sometimes can swing to losses, but this company is stable. And then if you look at it, their dividends as well, they also are a good dividend paymaster. So I think every year since fiscal year 2012 until fiscal year 2021, even during a tough time of COVID, they still pay out dividends, a bit lesser. But at the end of the day, because profit has been flat, so the payout ratio or the amount they pay out will also be somewhere around there. They will not overpay, and I'll see this as a kind of factor that they are good prudential management that does not overpay dividends. So actually, they do actually qualify or pass a lot of our dividend GEMS hurdle, right? Stable, doesn't go into losses. Every year they pay, I would say, decent amount of dividends, right? But if you look at their historical valuation of CP, talk about price to earnings ratio. So you can see back in 2015, they were at PE 8.13 times, right? Then you forward back to the current PE. So they're currently at 7.5. So 2020, the PE went back up just because the share price stayed flat. The profit came down because of challenges they experienced during the COVID. But once everything recovered, then you see the earnings rebounded back. But the share price actually stayed the same. Hence, you get some sort of a compressed price to earnings ratio. The same goes to the price to cash flow. So you see, the one that is most inherent is the price to cash flow. Back then in 2015, they were around 7.7 times the valuation, price to cash flow. So forward to the current, which is 2020 or current fiscal year, their price to cash flow actually dropped down to 3.14 or 2.71, meaning to say that even though the company keeps on pulling in more and more cash flow, the price does not actually follow in tandem. So that's why you see a valuation compression. Company does actually perform, but the share price does not follow suit. And here you can see just basically the 5 years of share price movement. Share price actually came down during COVID, down to 50 cents, but after that it rounded back to RM1, which is practically what it has been trading at for the past 5 years. So you'll be wondering, it's a good, I would say, extremely sexy company, but it's not a lousy company. In fact, I would say it's somewhat an above average company, but why is the share price so stable and not showing any signs of going upwards, right? So this would be the good example of actually showing you guys what is value trap, right? Company does actually put in good performance, but the share price does not follow suit. So this is where you actually encounter a value trap. So the other definition that I think is also important to highlight is that value traps can also be a stock or other investment that appears to be cheaply priced because it has been allegedly trading at a low forward valuation metrics. So this is where the today's examples come to play, meaning to say that back then, 1 year ago, everyone was thinking that COVID would persist, usage of gloves will actually push your glove company's performances up, and they were giving in valuations like 70 times PE, 80 times PE, right? So even though it's 1 year ago, but I think many of these advisors still stay fresh in our memories, right? So it's the same, but apart from just catching a company that the share price also go up, but this one is the other way around. You think the share price will continue to go up, but eventually it did not, and then you probably bought the company, say for example at 8 ringgit, thinking you can actually go up to 10 ringgit, but in the end of the day, it came back down to 2 ringgit and 74 cents. So even if you look at the trading valuation, PE is 2.8 times, so very, very, very cheap, right? Just based on numbers itself, it's the cheap. And the dividend yield is 21 times dividend yield, 21%. So meaning to say that you're getting 20, you're going to take back your investments in 4 years' time if you invest, and Top Glove continues to pay out that kind of dividends that they did for the previous fiscal year. So I think just to refresh our mind back then, there were a lot of bullish thesis and bullish articles, not just from financial institutions, but also from a lot of investment education bloggers as well. So this is just a snapshot what people allegedly say. right? Even up to early this year, right? 1st of March, 11th of Jan 2021, and also back then in the September 2020. But just to let you guys know, I think just last year, August, so I think more than 1 year ago, I actually come up with a bearish article on glove companies. Right then, everyone was very positive on it, and I was the one actually on the contrarian side, saying that hey, probably you should take a deeper look at what are the risks out there. I know if vaccines were not so swiftly rolled out, definitely gloves companies might continue to do well, right? But there are risks, and you have to actually acknowledge the risk before you actually call that or think that the companies in terms of the share price and performance will continue to go up. So you just go through the 5 risks and see how many of them 1 year ago until now, how many of them have actually came to fruit, right? Actually came true. So the first argument that I actually put on was, will there be a permanent pandemic-driven volume? So back then, I still remember some of the articles say that, yeah, even though COVID is over, the number of gloves that people will use will continue to be at the high level, meaning to say that we will be more protective of ourselves and we tend to use more gloves. But if you look at the Top Gloves' latest quarterly reports, you see that their sales volume was also lower. So meaning to say that people are not actually using that much gloves as what we imagined back then, right? So when pandemic actually slowly recovers or slowly gets over the pandemic, the usage of gloves, the frequency of changing gloves will also go back to normal as well. And this actually jives back with the previous pandemics that we have encountered. Right? This is not the first time we've encountered pandemic. And back then I was thinking that, yeah, if COVID is going to be over, I think that the usage or the frequency of changing will not be that much. So that was the first argument that I had back then in August, and it actually came true. And you can see that from Top Gloves' latest quarterly results that they actually acknowledge that, yeah, the volume has actually dropped by 33% already. So this is the first predicament or estimation that we made back then that actually came true, right? So if your volume doesn't stay at a consistent rate, then that means that there will be chances that your revenue does not stay, and it will also impact your net profit as well. So the second one was, is there going to be a permanent higher average selling price? So back then, when gloves were a scarcity, people were asking for gloves because they wanted to get PPE prepared and arm their healthcare workers with gloves so that they can treat their patients. So our glove companies actually enforce and increase the average selling price. When you have higher demand, the supply is capped, it's normal supply chain dynamics that, yeah, prices have to go up. And that was also where your glove companies made a huge beating in terms of their, COVID pandemic fiscal year bumper earnings. But back then was also thinking that, what if pandemic is going to be over, then will the average selling price stay the same, right? So if you look back, now we go to Supermax quarterly reports. So they also acknowledge that global glove prices have also begun to decrease, and the decrease have dropped substantially. So from there, you can straight away know it's not just a drop, a minor drop, it's a huge drop in terms of the average selling price. So the spot prices is much lower than the contractor's price. And if you don't sell enough volume, you don't sell it at the higher average selling price, these are not consistent, then your higher valuation of glove companies does not make a strong argument. So the third one is also quite important, would be the foreign exchange. So if you look back last year, I think, when it was 2020, so that time, I think Forex rate was quite good, 4.2-ish, right? But Forex is still going to be volatile. So I think right now, as of today, the Forex rate has dropped down to 4.15. So if companies in Malaysia, they sell their stuff in USD, and the Forex is actually strong, your ringgit is strong, then translated net profit will also get impacted as well, right? So this one, they didn't actually blame it or cite it as an important factor of their decreased profit. So out of the 3 factors that we have gone through so far, 2 of them actually came true. So next one would be permanent favorable war material prices. Will that also continue to help glove companies bolster their earnings and also revenue growth? So this one, I don't think they actually cite it as an important factor that caused their drop in revenue or profit. But nevertheless, if this also comes to picture, then I think that in terms of their earnings, it would be much more affected as well. I think lastly will be the permanent global demand reliance on Malaysia. So we know that Malaysia played an important role in supplying gloves all around the world. I think we supplied close to 60% of the global gloves requirement coming from Malaysia itself. So you can see that we do have a kind of body or governing body that helps to collaborate or to make sure that Malaysia Gloves interests are well protected. So this is under the MAGMA or the Malaysia Rubber Gloves Manufacturing Association. So they also will provide their annual forecast of what would the glove consumption be like on the annual basis. So roughly around 12%, 30%. Some years, if they think that growth is going to be a little bit good, better, so it will be around 15%-ish. So they gave also a bullish forecast that COVID will actually make human beings use more gloves. I think their latest forecast back then, 2020, was actually much higher, but it did not come to fruition as well, as we see that glove companies have reported their lower average selling price and also lower sales volume as well. So you can see that it is also true that people or countries around the world are wanting to prepare themselves for the next pandemic. They don't want to actually go through the same experience of relying on Malaysia only. So going back to Supermax Q4 results, you can see that they did highlight also, there are also other new players from other countries like China, Malaysia, and Thailand who are also entering the glove business as well. So when you have more and more players, you have alternative suppliers. And to be honest, upfront, from my opinion of view, gloves are not branded. If you don't get to buy gloves from company A, you would happily settle for company B because the functionality of the gloves is much more important and vital compared to which company is producing it. So here you have it. So 5 factors, 3 of them came true, and a drop in revenue and a drop in profits eventually led to the collapse of the share price. Right. And just to also highlight that value traps are not permanent. Like if you bought it back then at 6 share, day to day you are actually trapped. But for those who are actually not bought into glove companies shares, say for example now it's at 2 ringgit and 74 cents, it could be a potential value stock for you and me who have not actually bought or have any long position on glove companies, right? So it's a perspective of things, right? You might be trapped if you bought it at a high price, but for those who have seen the share price, as we share right here, correcting downwards, it actually potentially could be a value stock for those who are looking at it right now. Right? So how do we actually detect and eventually avoid value traps? Straightforward. You have to actually do a valuation comparison, right? You might even need to go to the extent of comparing peer-to-peer companies. So straightforward, if you look at YOCP, the historical price to earnings and price to cash flow has been trending down. There is a distinct sign that company has valuation compression. The company's performance improve, but the share price does not tag along with it. So this is straightforward. A value trap, if you look into it straight away, don't buy, right? If you bought into it earlier on the years, fast over 3 years, you don't see any improvement in share price, but there is some company performance improvement, then it's really up to you. If you have a decent dividend yield from the company, you might actually hold on to it. But if you think that you have found a better company, then by all means, you can actually take profit, cut a little bit of loss, and switch your capital over to a more predictable or more potential company. Right. The second one maybe is also quite important is to look at how the management and the corporate governance of the company. So this just happens a few months back. I think we have a specific video or article covering about it. So basically, if your company's managing executives do not actually honor or respect corporate governance, like calling auditors, giving nasty remarks on your independent auditors, then it basically means that the company is very denial in certain aspects that the auditors think that, yeah, you might have actually overlooked something or you might have actually did something wrong. So acknowledging and trying to solve the issue is much more important than going into an argument with it. So this company, I think as of now, the share price is just 40 cents. Those who think that the appointment of a better auditor would save things eventually do not see their dreams came true lah. So the other one would be, I think valuation compression, we just talked about it. Then, and the third one would be by comparing the income statement and also the cash flow statement as well. So there might be companies out there who can report sustainable, stable profits on their income statement according to accounting standards. But when you look at their cash flow statements or their operating cash flow, they do not seem to be able to pull back or pull in sufficient operating cash flow to match their income statement. So this is also, I think, the same from Serba Dynamic. So you can see that for the year of 2021, the latest fiscal year, they actually have some difficulty in churning out positive operating cash flow, even though on the income statement wise, the profit is actually very, very stable and even on an increasing trend as well. Right. So I think last but not least is also to challenge bullish thesis arguments out there, opinion articles that you might read, or the news articles that you might read. So what transpires me to write a bearish article on gloves was everyone on the street was so confident about glove companies. And when I went through their justifications, their arguments, they were like, loopholes and you know, rooms for argument that what if this happens, right? Then your argument is not valid. So sometimes it's not asking you to predict for things to come 100% true, but just have that thought in mind that what is the downside if this kind of scenario would happen. So based on the 5 points, 5 factors I actually highlighted, we did not actually venture or have any long position or even participate in any trading activities on glove stocks for the past year. Before COVID, during COVID, and until today, we never traded, nor we have held any glove stocks. And this is where today's sharing and lesson comes to you guys. Right. I think the summary is straightforward. We all want to buy stocks that can actually go up indefinitely, have ever-growing capabilities and prospects, but do not get blinded by the upside until you forget what about the downside. There's always risk when you buy into a company. You have to be confident and comfortable with the downside rather than very, very confident by the upside. Then only when the stock has no more reason to fall, then only it will rise. So this is also my mantra when I find into companies to invest. If the company is super rock solid, there's no reason for the stock to go down. I would actually be happy to allocate a high capital to it. If it's a highly potential stock, but there is still some risk right there, the capital allocated will also be there, but in a smaller amount. Right, I think that's about it. I think straightforward and having a real life example to justify my point of view or our point of view on what value trap is serves as a reminder to you guys and also to us. Hopefully that you're able to notice it, before we get trapped into it whenever we find our potential next investment candidate to add to our portfolio. So of course, thank you for being a Premium Club member. If you have any questions, we will attend to them. And of course, do catch us as always on our weekly Not So Late Night show. I think there is one that just went live just now on Farm Fresh IPO. Do check it out and leave us any questions that you might have. Right, so I'll pass it to Chun Bing. I think you haven't highlighted or shared with us that do you actually encounter any value traps when you started investing until today?
Yes, I think personally, one of the thing is you will actually look into the company and you think it's very, very potential due to all the news that is actually coming out, right? So when the news coming out, then you buy on news, for example, in the earlier day, then you will tend to believe it will be realized soon, even though the financial figure might not be right. So it's operating at loss. It's just having a very sound statement that is actually telling you in 1 to 2 years' time, the whole thing will be different. So this kind of thing is very dangerous. If you're purely based on the thing coming from a statement from the management, without comparing with the peers, with other more non-neutral kind of source. And then, of course, when it fall, and then you didn't really react, after a while, you think it's a place that no return. So it's either you cut loss and feel the pain, or you just leave it there until one day it may come back. So personally, I encountered that. Second one is, I think, is by chance. So I think the second one is for me is AirAsia. Of course, I bought it before the pandemic. Particularly, it's during the scandal that I think Tony Fernandez was saying he was accused for actually doing some bribe or whatnot. I forget the exact incidents, but
I think the Airbus scandal.
Yeah, after we went through, then we think is actually not the case. So I was confident that people are selling on news.
Yep.
But yeah, I bought in. Then of course, I think 1 to 2 months later, pandemic, it fall too fast that you don't really have any time to actually react. Then it's the decision of whether you wanted to average down or not. So
Yep.
for me, I don't know about pandemic. I think it might prolong, so I just leave it there. And recently, I just sold it due to the border is opening up. So I think it's a good chance that it might bump up because of new as well. So I just sold it due to a few key reasons. Border is opening up. People think might straight away link them to retail rates, travel related transportation. They'll think straight away will bump up. But the fact is, for a guy to actually go and travel, the cost is very, very high. Think of it, even though you can buy AirAsia tickets, go to London, but you need to do so many checks, quarantines, or whatnot you might not know, and you need to buy more insurance. So it becomes harder to travel. So this is one thing. Secondly is the crude oil price is actually at one of the peak in the recent 1 year. So all these things is a bad news to AirAsia, despite the border is opening up. So due to that thesis, I think I should sell it because I believe people that buy on news will give room to people like me to actually take profit lah. So I think when you are falling into a value trap, do monitors. There might be some seasonals, exciting news or whatnot that help you actually get rid of the trap. But you need to know what is really going on. Not because border open up, I buy more. Need to think twice. Yeah.
Yeah. So I think that's also a good example apart from a top growth. Pandemic might be over, but I think much more challenges awaits Asia, and we can be too bullish also, just because pandemic is over, borders reopen, and operations can go back to pre-pandemic kind of honeymoon levels as well. So I think that's about it. If you guys have any questions, but not able to catch us live, you can actually highlight your questions at the Kaya Plus Premium Club Facebook group. We will attend to them. And if you have companies that you are in doubt whether it might be a value trap, we are more than happy to also take a quick look and then give our honest reviews and advice as well. But then again, just take it as a neutral opinion, but do not take it as a buy call or sell call, right? So I think that's it for today. We'll catch you guys in the next private session, as always, on a monthly basis. But in the meantime, do feel free to catch us on Facebook, the Facebook Premium Club group, and also catch us also on our weekly Not So Nice show. Do catch out the Farm Fresh video, which I think is quite an exciting one. Right, see you guys and take care. Bye bye.
Action. How was it, guys? I hope that you actually enjoyed this sharing session and you actually pick up some valuable tips, lessons, and can relate the examples on how to detect and avoid the next value trap in your investment journey. Of course, if you do like the similar videos, we do actually have lots of it, as we do come up with such kinds of video on a monthly basis for our premium club members. And if you're interested to join us, do check out the link in the description box. And thank you again for being a part of us and tuning in to Not So Nice Show. We catch you in the next week's episode. Let us know in the comment section on which company that you will want us to analyze and share. See you next week. Bye bye.